As of mid-2025, global debt has surged to unprecedented levels. The Institute of International Finance, IIF, reports that total global debt reached about $337.7 trillion at the end of the second quarter. That includes sovereign, government, corporate, and household debt, a scale comparable to the debt explosion seen during the pandemic's worst months. At the same time, the share of public debt relative to global GDP remains high. According to International Monetary Fund, IMF data, overall debt stays above 235% of world GDP. Behind these headline numbers lies growing fragility. In many advanced economies, interest-bearing debt is maturing soon. Both sovereign and corporate debt, and a substantial portion needs to be refinanced under tighter conditions. According to the 2025 report from Organization for Economic Cooperation and Development, OECD, a large share of government and corporate bonds will come due in the next few years, raising refinancing risk. As yields rise and global central banks retrench, the cost of rolling over debt will climb. For many countries, especially emerging and developing nations, this pressure is already acute. Recent data from World Bank shows that between 2022 and 2024, these countries paid out $741 billion more in external debt principal and interest than they received in new financing, the largest gap in at least 50 years. Although some managed to restructure debt or access new loans, the new borrowing often comes at much higher interest rates, sometimes near 10%, roughly double pre-pandemic levels. With global economic growth stagnant or slowing, many economies find themselves trapped. Growth is too weak to outpace debt servicing costs, yet borrowing costs are rising. If interest rates stay high or rise further, the burden of debt service could choke public finances, corporate investment, and consumer spending, triggering widespread fiscal stress, defaults, or restructuring. That's why 2026 is poised to become a turning point. If we enter 2026 without decisive policy shifts, this mounting debt overhang could trigger what might be called a debt storm, reshaping the global economy structure. First, governments may be forced into austerity, cutting public spending, reducing social services and infrastructure investments, slowing or reversing development gains, especially in poorer or heavily indebted nations. This could deepen inequality, reduce growth potential, and inflame social instability. Second, a wave of corporate deleveraging and defaults might hit, especially among highly leveraged firms that counted on easy refinancing and low rates. As credit conditions tighten, many businesses may be unable to roll over their debt, triggering bankruptcies or fire sales of assets. That could ripple through supply chains, labor markets, and financial systems, undermining investment and growth globally. Third, capital markets, once seen as safe havens, may become volatile. Sovereign and corporate bonds could see downgrades or mass sell-offs. Investor confidence could erode, reducing global liquidity and shrinking capital flows, particularly to emerging and developing economies that depend on foreign capital to fund development, trade deficits, or refinancing. As a result, we may witness structural changes, economies shifting away from debt-driven growth toward more conservative financing models, governments rethinking heavy reliance on borrowing, increased emphasis on fiscal discipline, and perhaps new international financial cooperation or reforms to manage systemic risks. For individuals and businesses, the consequences could be serious. Higher borrowing costs, tighter credit, reduced investment, lower consumer spending, perhaps slower wage growth, or even recessions. The world could see a pivot away from the debt-fueled boom of the last 2 decades. So 2026 might not just be another year. It could be the moment when unsustainable debt dynamics force a reset of how global economies operate.